Started with $1 and a dream. This one for all the people that said I couldn't do it.
Good day, Forex Chasers. Speaking to you is Lisiba Mutupi, the head of Forex Chasers Institution. Thank you guys so much for making it on our lessons, and we really do look forward to walking alongside this journey with you guys. Now on lesson 1, what we'll be speaking on is the introduction to Forex. The topics that we'll cover is what is Forex, the business of Forex, Forex terminology, currency pair codes, contract lot size and calculating lot size, types of traders. Now let's start up with the first topic. Introduction to Forex. What is Forex? It is the buying and selling of currencies at an aggressive rate. It has no central marketplace and is conducted over the counter and is therefore direct trading and is not in standard form. The broker effectively transacts the trade for you, and so the trade is actually between you and the broker, not another trader. It can also be defined as speculations of one currency against another in a pair. Whether you buy or sell, you speculate that one currency has power over the other in the same pair. It runs 24 hours in 5 days and is the largest compared to stock market. As we know that the Forex market is, the industry of the Forex market is worth $6.3 trillion, and the industry of the stock market is worth approximately $600 billion. So the Forex market is the largest compared to the stock market. Okay, now let's look at the business of Forex. It requires minimum capital investments, meaning that you can start with as low money as you've got, as little money as you've got. It requires minimum time commitment to gain success in the Forex trading industry. What does mean is that since you're your own boss, you don't have to necessarily stay up all night just to be able to gain success in the Forex trading industry. You push yourself. So whatever time effort that you put in, if you're taking your own time if you're not putting in the work, then it might take 3 years. But if someone is putting in the work, it might take a year. So that's the difference. Time. It doesn't necessarily mean that you have to put in the time or don't have to put in the time. And the next point is there are no employees and no offices needed. You are able to plan your routine, build your business anywhere around the world. And B, making money in the financial market is easy. Keeping the money isn't so easy. Forex trading terminology. Cross rate. The currency exchange rate between two currencies in a country they are not official currencies of. Exchange rate. The value of currency in terms of another. For example, euro US dollar is 1,3200, means 1 euro is 1,3200 US dollars. Pip, the smallest possible price movement a currency can make. Leverage, the ability to control a large amount of capital with a comparatively small capital in order to gear your account into a greater position. This magnifies both wins and losses. For example, when opening a $100,000 position with just 1,000 as your margin, you magnify your account 100 times at a ratio of 1:100. We can say it is using borrowed funds by means of a contract to increase the ability of your investment and gain at a higher level, but at a higher risk too. Margin, the deposit required in your account in order to open and or maintain trades. It is deposited with the broker to secure the broker's capital from any loss depending on the contract agreed upon. Used margin is an amount maintaining an open position, and free margin is the amount available to open new trades. If a trade's account eventually falls below required margin, they receive a margin call, which notifies trader to deposit more capital or close the trade. most brokers automatically close the open position. Spread. The difference between the bid price sell quote and the offer price buy quote. Going long. When opening a position that can only be profitable if exchange rate rises, we can then sell back our position at a higher price than we bought it for. Going short. When opening a position that can only be profitable if exchange rate falls, we can then buy back our position for a price lower than we sold it for. Flat. When the trader has no open positions. Nature. The characteristics with which price is moving. Impulsive nature. Aggressive price movements with heavy momentum. Corrective nature. Tight low momentum compact price movements creating continuation and reversal patterns. Structure. The use of multi-time frames to draw in a framework of continuation patterns, reversal patterns, and outer trend lines. Price patterns. Reversal or continuation price shape pattern. Bullish trend or market. Higher highs and higher lows. We notice a bullish trend by forming higher highs and higher lows. Bearish trend, lower lows and lower highs. Scaling. When you add positions to an existing position, meaning when you've got a trade on euro US dollar, you sold euro US dollar and it's going down, it's giving you profit, and then it gives you another setup that you may be able to take a trade on. It's when you add a position on that, it's called to scale in. So now you have two trades instead of just one trade. Risk entry, entering a position before impulse out of structure. Reduced risk entry, entering a position on the correction after the impulse out of the structure. Progression, when price impulses out of the pattern, confirming direction. Momentum, the dominate move on the higher time frames. Sentiment, using price action to judge the dominant direction. Bias, using sentiment to gain a belief of a bullish or bearish stance. HTF, acronym for higher time frames, meaning it's 1 month, your weekly, and your daily. Lower time frames, LTF, your 4 hours, your 1 hour, your 15 minutes, and BE stands for break even. Currency pair codes. Exchange rates of two currencies are quoted in pairs because in all foreign exchange transaction you buy a currency while selling another at the same time. We've got GBP US dollar exchanging at 1,51258. GBP is our base currency, which represents 1, and US dollar is our code currency, which represents 1,51258. In the currency code above, the pound and the American dollar are paired, and we have learned that the picture above tells us that 1 pound equals to 1,51258 US dollars. Notice each currency has been labeled as either base or code currency. A base currency is the basis of the trade, therefore whether you go long or short, your position is based on it. To understand this better, we can say when you go long on this currency pair, it means you buy the pound and you sell the dollar, and will obviously at that point believe that pound has power over dollar. When you go short on this currency pair, it means you sell the pound and you buy the dollar, and again it obviously means that you would be convinced that the dollar has power over the pound. So whatever trade you place will be based on the base currency. Currency is quoted in pairs. Base currency always represents 1. All currency pair codes are seen in this manner. 1 pip is equals to 0,0001, meaning that 1 pip is equals to the fourth number after the comma. And all currency pair codes, including JPY, Japanese yen, 1 pip is seen in this manner, 0,01, meaning that 1 pip is seen as the second number after the comma. Example, US dollar Japanese yen. We're looking at US dollar Japanese yen. And let me have a drawing here. Okay, there we go. Since they say on US dollar Japanese yen, a currency pair that includes Japanese yen, it's the number. Okay, there we go. 0,01. Meaning that after the comma, it's 0,01. Here's our pip. This is our 1 pip. If this moves to 3, we moved up by 1 pip. If it moves to 4, we moved up by 2 pips. If this number moves, we don't count it. We only count starting from here. This is a pipette. We count starting from here. And if it does move and say it jumps over and pushes this one to run off, this one moves to 8, we have moved by 10 pips. Instead of 1, we have moved by 10 pips. So now, okay, GBP, JPY, it includes JPY. It includes JPY. So they say it's 0, okay, 0,01. There we go. Here's our pip. There's our 1 pip. This is a pip, we don't count it. Now let's look at Euro AUD. Is there any Japanese yen? There's no Japanese yen. So it means that we're using the 0,0001. This is 0,0001. Here's our 1 pip. This is a pipette. We don't count it. We don't include this. It's a pipette. It's the very, very smallest. So here's our 1 pip. And the next one, it's AUD USD. Is there any Japanese yen here? No, there's no Japanese, meaning that we use the same one as this one. The same method as this one to calculate the pip. So it's 0,0001. Meaning that here's our 1 pip. Here's our 10th pip, our 10th pip, our 100th pip. Meaning that if this moves to 5, prices went up by 5 pips. If this 4 moves to, let's say, 6, this is 5 pip, this is 6. Prices moved by 65 pips. 65 pips. And a pip, what does a pip not mean? What does it stand for? It's price interest point. PIP stand for price interest point. Now let's look at the contract lot size. In Forex, positions are quoted in terms of lots, namely standard lot, mini lot, micro lot, and nano lot. Number of units per lot. Standard lot is 100,000 units. Mini lot is 10,000 units. Micro lot is 1,000 units. And nano lots is 100 units. Nano lots is 100 units. Okay, let me clear there. Okay, calculating lot sizes. Let us assume that we are using the standard lot size, meaning that we're using this formula here, 100,000. And we're looking at, there we go. And we're looking at US dollar Japanese yen. Now the price at US dollar, we know that the base US dollar would be 1 year. Japanese yen would be 98,728. To calculate how much is 1 pip using standard lot size, we take the pip, okay, 1 pip, the 1 pip movement, knowing that 1 pip is 0,01. If there was no Japanese yen included, it was gonna be 0,0001, but then now Japanese yen is included, so we say 0,01 over the code currency, which is 98, but you can see it's written this. Let me just, yeah, it doesn't have to be because it's already typed down there. It's the pip over the code currency multiplied by the unit. Since now we're using standard lot size, you'll see when you guys are choosing with your broker, they'll ask you guys what units do you want, and you choose the standard lot size, meaning that you know one lot size represents 100,000 units. So multiply by 100,000 units, 100,000 units, and our answer would be 10.12 dollars, meaning that each and every one pip that is moved, if we buy or we sell the currency using one lot, we're gonna gain or lose 10.12. Each and every pip represent 10.12 by one lot. Now let's look at the second example. Euro odd. Okay, let me clear that. Okay, euro odd. Is there any Japanese yen included? There's no Japanese. It's euro, it's odd. There's no Japanese. Euro, it's 1. AUD is 1,56664, meaning that we calculate the pip. One pip represents 0,0001 over code currency, which is 1,56664 multiplied by 100,000 units. 100,000 units, which it will give us $8.65. Meaning that if it happens that we buy, let's say we buy and then we buy here using one lot, and we buy on this one and we buy on this one using one lot, the same lot, one lot and one lot. This one moves 50 pips and this one too moves 50 pips. It won't give us the same amount. It won't give us the same amount. Let's say if it moves 100 pips, 100 multiplied by 8.66, how much is it? It's like $86. And if this one happens to move 100, it'll give us how much? $100. $100. So that matters a lot. We need to be careful on how we calculate our profits or losses. Okay, let's look at this table here. On this side, we've got euro. On this side, we've got dollar. We've got euro and dollar. Now, we said standard lot is 100,000 units. Standard lot is 100,000 units. And this is our code currency. Here's our code currency. This is our base currency. One lot. Base currency always represents one. One lot is 100,000 and code currency is 135,100. Now it happens that we are in a long trade. We buy this per year. We buy euro, US dollar. We long it. And with one lot size, 100,000 units. And it moved from 135,100 to 100. And when it gets to 135,500, we exit, we sell it. Meaning we bought it. That's why we see our positive sign. Then when it got to 135,500, we sell it. We made a profit of 400. So we can see ourselves making a profit of $400. But now without leverage, we would have to invest 135 to earn 400. 135,100. We would have needed to invest this amount just to earn this amount. So without leverage, we would need a lot of initial capital just so we can make such profits. Now, thanks to leverage, we are able to make such profits with small amounts. Two, it means that it doesn't mean that we only benefit from the broker. Two, they can also benefit from us when we take a loss, because that will mean that they get the same money back. So leverage and margin. So this diagram represents 1:10, meaning that when your leverage is 1:10, the margin that will be required here to open a position is 10%. When your leverage is 1:10, the margin that will be required is 10%. So meaning that if it's 10%, you can't exceed more than 10 trades. You can't exceed more than 10 trades using one standard lot size. And when your leverage is 1:20. 1:20. The margin required is 5%. 5%. That means you can't exceed more than 50 trades using one standard lot size. When your leverage is 1:50, the margin required is 2%. The margin required is 2%, meaning that you can't exceed more than how many trades is it? Okay, and when the margin here is 1:100, when the leverage is 1:100, sorry about that. When the leverage is 1:100 and your margin is 1%, the margin required is 1%, meaning that you can't exceed more than 100 trades using one standard lot size. Now, other brokers, they offer way more than this. They offer way more than this. They can be like 1:500, 1:880. I can't name them, but then others would say 1:880. It's a good thing, but when you take a loss, you take a loss. When you take a loss, you take a loss. That's how it works. Okay, now let's look at the next page. Let's look at the next page. I believe that we saw how the margin works, the leverage and margin works. And now, okay, sorry about that. I'm not supposed to be making such sketches. Types of traders. We've got discretionary trading. Depends on a trader's gut feel or discretionary trading skill to analyze and trade the market. Discretionary trading allows for a more flexible approach than automated trading, but it does take a certain amount of time to develop your skill. Most professional traders are discretionary traders because they understand the market is a dynamic and constant flowing entity that is best traded by human mind. Technical trading. Technical trading involved analysis of market price. For making one's trading decision, technical traders use price patterns or technical signal to trade the market with an edge. The common belief amongst technical analysis traders is that all economic variables are represented by and factored into the price movement on a price chart. Fundamental trading is a trading technique wherein traders rely heavily on market news to make their trading analysis and predictions. Fundamental news does drive price movement, but oftentimes the market will react differently that what a particular news release would imply due to the fact that market participants often buy on expectation of future events. This is another reason, main reason many pro traders rely, I think I made a mistake there, sorry about that. Many pro traders rely more on technical analysis than fundamental analysis, although many do use a combination of both. Number 4, the type of trader. Scalping is similar to day trading, but it relies on more frequent and shorter term trades than even day trading does. It is a style that refers to jumping in and out of the market many times a day trade. It is a style that refers to jumping in and out of the market many times many times a day to scalp a few pips here and there, generally with little regard for placing logical stop losses. Scalping is generally not recommended by experienced professional traders because it is essentially gambling. Scalpers target 5 to 10 pips per trade and they use a time frame of 1 minute and 5 minutes. Now, scalpers are, to explain the scalpers how they trade is that the trades don't last up for more than 15 minutes roughly. They don't last up for more than 15 minutes, meaning that once they're in a trade, they'll look at the market, they'll look at their phones up until the trade gives them that small pips that they want and they take the loss. Disadvantage about this is that most people, if once it starts to go against them, they say or they have a belief that it will come back and they'll cut the losses. But then it goes to more losses and then eventually would lead up to blowing an account. Okay, day trading. Traders who day trade the market are in and out of the market within 1 day. This means they typically buy and sell currencies over a short period of time, and they may enter and exit numerous trades in one day. They target 20 to 50 pips per trade. They use a time frame of 15 minutes, 1 hour, and 4 hour. And one thing that I know or I realized about day trading, I used to be a day trader. One thing that they do is that they're not comfortable with going to sleep having trades running. That's something that they're not comfortable with. So before they sleep, if they're sleeping at 10, before they sleep, all trades are cut. There's no trade running. They'll just see according to their journal whether they made a profit or made a loss, or they made a loss. And then from there, the next day is another day. The sixth one, swing trading or position trading. This style of trading involves taking a short to mid-term view on the market, and traders who swing trade will be in a trade anywhere from a few hours to several days or weeks. Swing position traders swing opposition traders are generally looking to trade with near-term daily chart momentum and typically enter from anywhere from 2 to 10 trades per month in average. They target 50 to 500 pips per trade. They use a time frame of 1 hour, 4 hour, daily, and 1 week. Now, swing traders are traders whereby they can open a trade today. They don't look at their phone. They don't keep on looking at their phones each and every hour, each and every second or minutes. But what happens is each and every day, they'll just rather judge how their trade went. Did it break the high? Did it break the low? Is it still continuing? Do I still see the same setup that I took? And their trades can last for more than, they can even run up for weeks. And they capture more pips. That's the advantage of day traders. I mean, swing traders and position traders. And I believe that's what even the banks do. That's what the banks do. Now, I'd like to say thank you guys for watching the first lesson. And I hope to see you guys on the next lesson. Thank you.